from your background and your expertise, could you explain to us what is the economic downturn that we're experiencing right now?
It definitely feels like a downturn, and there's lots of numbers and news that is kind of pushing it. It's being covered like one. But really, the way I'd classify the current situation is a normalization across two different time periods. The first is really the past couple of years, the pandemic, very much a truly unprecedented event in time for the global economy at a time when our global economy was more interconnected than ever before. The profound impact that the policies had in terms of quarantine and shelter in place, like how that changed productivity, how that changed interaction, how it changed, basic economic relationships that had been the case for many years / never changed. So all the kind of unprecedented dynamics there, and then what the governments did to respond to that, not only in terms of the shutdown orders, but to anticipating, hey, this is a global, change. This is an unprecedented situation. What can we do? We can take all these steps. We can have monetary stimulus. We can do loans to small businesses that they don't have to pay back. We can put checks in people's accounts. So they took all these kind of unprecedented steps, kind of viewing that staving off, bigger challenges if you had the means to do it, and literally injecting trillions of dollars into the economy. And it's basic supply and demand from there. That's why prices went up. When you inject a lot of liquidity into the environment, you're going to have prices increase. You also kind of had other changes that happened as a result. A lot of people talked about supply chain shocks, etc. Stuff that happened coming out of the pandemic, in terms of Russia and Ukraine earlier this year. That also had a challenge. So really, this normalization and change, what it is prices have significantly changed. So that's when we talk about inflation, we're really talking about prices and how those have changed in the response to stimulus. So I think that really what the markets and the economy is trying to figure out is, how do we normalize from the pandemic? There was all these underlying shifts that change the supply and demand and prices. How do we normalize through that? We can't keep injecting trillions of dollars into the economy indefinitely. So I think a lot of businesses are trying to understand and anticipate, what is that forward environment like?
I think one of the big fears that a lot of folks who haven't studied up on the finance and the research of it is this 2008, right? Is this the recession that we had before? Evan, could you sort of explain in your terms, is this not, and why not?
Yeah, history doesn't repeat, but it rhymes. I mean, I don't know. I don't know what the future will hold. I definitely know it's not a housing crisis that is starting a global recession. So this one is certainly a little bit different. But hey, I mean, the term recession gets thrown around a lot. It's even been questioned by the government and what that actual definition is in the last week. But it's usually two quarters of negative GDP. So that's something we've experienced. So we have kind of a technical recession right now. But really, from my standpoint, kind of talking about that, and this is a graph I shared, it's really this kind of concept of the interest rate environments. That's how I'd link the two things. Really, the big change is interest rates are rising. And for anyone who started their professional career or their investing career after 2010, like myself, I mean, I started on Wall Street in summer of 2010. I've never known an interest rate environment where Fed funds was 3%. If you look at historically dating back to the 1950s, and I shared a graph that kind of shows that Fed fund rate over time, what you really will see is that the most recent 10 years since the 2008 crisis has been the outlier. Having interest rates at zero for this long is unprecedented from a monetary policy standpoint. And really what that was about is that in 2008, there was a bubble, asset prices crashed, right? Stuff that people thought was worth a lot was worth very little. And getting the economy kind of kickstarted again, what the government did is something called quantitative easing. They were effectively buying their debt. Again, gets into the kind of economic fundamentals, supply and demand. If the government's buying their debt, the rate goes close to zero. And really what that allowed is that it was very easy to borrow money. That is how a lot of companies have been built. That's why there's been a lot of deployment. When interest rates are at zero, there's a premium on growth. That's why there's been so much capital allocation to growth sectors, to technology, to venture, et cetera, because people are looking for growth. When interest rates rise, that calculus starts to change a little bit. You can get 2-3% by just sitting on your hands in the least risky asset, which is the U.S. Treasuries. So it's really, that's kind of the dynamic we need to consider, is that, hey, is it a normalization back to a few years ago, or really is it a bigger normalization back to previous times, and it's the Fed funds rate. So going back to the 1950s, it's one of the other graphs. But really, what you'll see there is that these kind of short period, the low interest rate period is definitely the outlier from that standpoint. You can see, and this is a good way to kind of talk about the Fed, because I feel like people don't really know, oh, the Fed, what does that actually mean? The Fed is a government body. It's a government entity, and it was quite literally started just over 100 years ago in response to the crisis, the kind of panic of 1907, when there was a huge stock market crash, and the government, under Roosevelt, basically was like, hey, we need to do something about this. We can't just let this happen, because the U.S. didn't have a central bank before then. Again, this is history of the United States type stuff, but for over almost 100 years, kind of from the original, from kind of Andrew Jackson eras, there was this period of time where there was no central bank. It was kind of just the market and different pools of private capital. So the Fed was established as kind of this overall liquidity provider to kind of stabilize the economy, the kind of lender of last resort, to make sure that these type of crises don't happen. And over time, the role is really expanded. But what is the Fed? The Fed is 12 different branches, really different smaller banks across the nation: San Francisco, St. Louis, Minneapolis, etc., Dallas. And really what it is it's a gigantic, regulatory and economic research organization. Something that when I worked at the banks, we would talk with the Fed on a pretty frequent basis, present to them. The vast majority of the manpower and time done at the Fed is on research. It is in looking in the numbers and having these teams that are digging into what's happening with small businesses, what's happening with banks, et cetera, and really formulating policy based on that economic research. And I feel like a lot of times people just think of the Fed as making these decisions. Really what they're basing this on is on economic research over time, and having teams and teams of people looking into this, talking to the industry. That's why they're talking to the banks. They want to understand what's happening. They're not necessarily the policemen, 100% of the time. They're really meant to safeguard the overall economy.
What do you see the Fed doing in the near future? And
so the Fed has a dual mandate. Yeah, that's kind of the best place to kind of start, is really the dual mandate of the Fed, which is to maximize employment and to keep low and stable inflation. The Fed doesn't want to have hyperinflation. This has been something that, again, economic kind of history, economic policy, inflation is the thing that leads to depression. So when you have these rapid dislocations in prices, it leaves a lot of people unable to meet their needs. So really, you never want to have that runaway inflation. So how do you stop inflation? You change interest rates, and that's why that has been kind of the blunt force measure that's happened. Because when interest rates are higher, people are incentivized to keep their money on the sidelines and not keep pushing up prices.
Is there anything that folks should watch out for? Are there negative side effects?
Yeah, absolutely. Dramatic changes in interest rates, right? Seeing these big swings in interest rates. This has been the most volatile period of time for interest rates over the past decade. We saw, the 10-year Treasury go from below 1% to 3% in a few months' time. That has a knock-on impact on everything, on mortgage rates, on lending rates, on how banks and businesses finance themselves. And really, the way I would crystallize that is cost of capital, right? If you're a business, from a large corporation to a small corporation, in order to get access to capital, there's a cost towards that. When interest rates are zero, getting capital is fairly easy. When interest rates are way harder, it's different. Everything becomes more expensive. And that's kind of the entire idea of how interest rates combat inflation, is that when interest rates are higher, everything's more expensive. Prices can't run away as quickly.
And to clarify, when you say cost of capital, do you mean just like loaning from the bank, right? Getting a bank loan, interest rate on that?
Correct.
Or do you mean like fundraising in more traditional, like angel investment fundraising, VC fundraising? Does that get impacted as well as a result of what the Fed is doing?
Absolutely. There's an interconnectedness with all of this, right? Because really, you can trace a lot of it to the bigger and bigger pools of capital. For example, one of the big sources of capital for venture capital firms and is asset managers and also pension funds, right? A lot of pension funds have given money to private equity, to venture capital, to alternative assets as a way to get more yield, to get higher returns, because these are riskier but higher returning assets. Okay, why were they doing that? Because interest rates were at zero, so they needed to find a place where there was growth. This gets back to this premium on growth. So what does that mean for the current environment? Well, if interest rates are going up, that calculus starts to change for these pension funds. They don't need as many alternative assets potentially, because they can have a safer portfolio and get paid, 3 to 5% for doing relatively nothing. And then there's also the kind of knock-on impact of, corporate bonds, et cetera, instruments that are not as risky all of a sudden have a much more attractive kind of risk return payoff. So in terms of, the environment, higher interest rate environment, you would historically think that that is not as positive for alternative asset classes as a low interest rate environment. Nobody knows what's going to happen next. If you take anything away from this, it's like, this is truly unprecedented. These are systemic things that are happening. There's certainly going to be a lot of articles and podcasts, and there's plenty of content to consume about it. But nobody really knows what is going to happen. And when you've lived through, market cycles, which I've, made it through at least one or two, you see a lot of people that are, look great one day and then lose their fun the next. They seem, some of the big winners from the 2008 crisis, guys who made, billions of dollars and called the market perfect. They gave it all back in the subsequent years with bad trades. So it's really, this is a very uncertain environment. The moment you think you have everything figured out is when you can get in a tough spot. I'd really, what I would say is to embrace the kind of uncertainty. Don't outsource, the truth to some expert. If people who, and maybe to turn this kind of to founders in the early stage, if you're listening to this and you're a founder, like you're building a company, and by nature taking a long view. You're not trying to maximize for the next 6 months to a year. Even in a kind of worst case scenario, this type of situation could be a multi-year thing. Hey, that's when a lot of companies are just kind of getting rolling, right? And really getting that product market fit and moving on, is a year plus, on. So, don't necessarily, some of the advice I've given our portfolio companies is like, don't over focus on optimizing for the next month or two, unless you do have a funding challenge. Don't overcorrect based on this. It's good to know about the kind of overall macro landscape. You don't want to be out of touch with it. But you also, a lot of these dynamics, they have fourth or fifth order impacts on your company. It's not, unless you're, you're not a macro hedge fund that is riding on every day and what the Fed is going to say. So don't take that kind of pressure on. And as there's 2% moves in the NASDAQ down or 5% moves, don't get too worried about your future IPO price.
Absolutely. Actually, let's switch gears into the specifics. You working with your portfolio companies and speaking with your fellow angel investors. What are founders doing, or if anything, to adjust and react appropriately to the economic downturn? What would you say folks should do or keep in mind? What would you recommend?
Well, I think there's a slight differentiation there, kind of what's happening and what I would suggest. I think number one is people are listening. I think people are very, very in tune to what is happening, which has been great to see. I think that we've seen a very quick kind of shift in focusing on burn, not kind of a growth at all costs mindset, maybe being a little slower on hires, a little slower on doing some of the kind of deployment, et cetera, not paying for sales type stuff, because that's the feedback they're getting from the market, from people, is really focusing on burn. Companies that have been around for a couple of years, really looking at the figures and extending their runway, because we've been in an environment for the past couple of years where it was, running a Series A process, or, take a few months, raising, additional capital, could be a few phone calls. Those dynamics are all changing. Everything's taking longer because people don't know what's going to happen. And you have to always put yourself in the shoes of the people on the other side of the table. A lot of investors, you don't know necessarily how their portfolio is looking. They could be sitting on large losses or paper losses, or had a huge paper gain that they don't necessarily think is going to be the case. So there's a lot of uncertainty from their standpoint. They're not as eager to rush into deals as they may have been when times were good. So really kind of taking that into consideration. I think companies are raising more capital, as they have kind of inside rounds. We've seen a couple of portfolio companies, reach out to existing investors, people who believe in them from the beginning, as they're kind of looking to extend runway, because again, everything is expected to take longer. And I also think, turning the revenue switch on earlier, being able to demonstrate the ability to generate revenue, kind of get towards profitability quicker. These are these are changes from, a year ago, when the priorities were a little bit different in terms of TAM, in terms of growth, in terms of getting more products out sooner.
Absolutely, and that very much aligns with the research that we've been doing, including our talks with you as well. VCs are having challenges fundraising, so the amount that they're investing has gone down. The due diligence process has, in your words, gone back to normal. Not like 24 hours, hey, we'll invest, right? Like there's actually a due diligence period. Valuations, it sounds like, from your perspective, has also normalized, not, where valuations may have been blown up in the past few years, where cost of capital is low.
Well, I think there's two kind of elements on that. One just on valuations, because that's a focus. Again, it's that normalization going towards the historic averages, et cetera. And I think that the public markets, again, are a great tether to that. When in the public markets, stocks are at all-time highs and public SaaS companies are trading at 80 times earnings, et cetera,
right.
Low, earlier stage companies can be trading at that, if not higher, right? Because they're higher growth. So when all of that gets pulled down, and a lot of these growth stage investors, et cetera, have their portfolios marked down, and all of a sudden it's trading at 40 or 50 times, or even less, close to 10, 20, they're thinking about the private market valuations differently. So even though it's private versus public, those public market indicators you're not going to see deals priced, the same way. And then the other one is like, there is a lot of, I'm sure there could be VCs that listen to this. Obviously I'm an investor in, VC firms, so, very positive about that industry and it's part of the ecosystem. There's a lot of dry powder in venture capital. A lot of these funds have been raised, and you can do some quick research and see that the dry powder is at an all-time high. A lot of these funds have also done incredibly well. They have a lot of money. They're also they're very astute at what the environment is. They're not going to keep raising against themselves. So I think that the narrative of the economy is really bad, valuations needs to come down, we're not willing to pay as much, that very much benefits the capital allocators, right? They don't want to pay ridiculous premiums. So a little bit of it is self-manifested in that regard, because again, these are private companies, right? So I do think that it's not a doom and gloom type situation when you look at, hey, what is the actual capital that is going to be going into these? And I think that a lot of people have done incredibly well investing in seed stage and early stage companies. They know that that's an incredible growth engine for the economy. And if anything, it's a fantastic time to be in these companies that, again, are multiple years away from public markets or even their next equity round, because you get to kind of weather this storm. I think that the companies that are in the toughest spot right now are the pre-IPO Series C plus companies, because they're the ones that took a lot of capital, potentially in the last year. They're at a really, really high valuation in their last round that it's going to be very difficult for them to grow into in the current environment. So what is the dynamics there? They're looking at fundraising at a lower valuation. That's going to compress everyone. But also that has a real impact on their employees, right? On sentiment, on culture. When your employees who just came aboard are all underwater on their equity packages, you have to acknowledge that that's going to affect people, right? And then at the same time, to kind of turn it to a early stage space, and what this kind of means for people and how founders can kind of take advantage when you're, whether you're in the current, YC batch or in one of the past couple, the last few years, the competition dynamics are really different. The Shopifys of the world are shrinking. They're not going out and launching new products and competing more. So the competition kind of upstream is changing. There's going to be, less and less companies, for example, a company like Robinhood obviously is going through some challenges. That's an opportunity for startups that are focused on a similar product, right? Because Robinhood is not able to just throw money at that. And then I also think that, fundraising is tougher, but there's less competition downstream because it's harder to raise. If you are able to find the right financial partners and you are able to raise around, you've done so in a much tougher environment. You don't have to be looking over your shoulder that in a week there's going to be someone with the same idea and a few $1 million that's going to be going after your market. So I view kind of the benefit in this, definitely tougher, but for the kind of seed to series A, B companies, there's less competition upstream, and I'd argue that there's less competition downstream as well.
Absolutely, and that's a tip that YC has also given us is, during an economic downturn, all you gotta do is survive. If you survive, you can beat out most of your competition, because that's when a lot of folks, get knocked out. So last two questions regarding, what you were just saying. what are the opportunities and how can founders take advantage of them? How can they position themselves or pivot how they think, or, you know, see this downturn as an opportunity? And then any tips for that? And then the second question is tips for fundraising. You mentioned going back to existing companies, right, who believed in you from the start, and things like that. But yeah, so, you know, tips for taking advantage of this opportunity and tips for fundraising during this time.
Absolutely. I think we can answer them kind of in tandem. I think that obviously it's a different environment. But, you know, again, don't take a short-term view, because that's not necessarily, you know, you want to be smart with your costs and expenses, et cetera. That goes without saying. That doesn't matter, you know, just because you can raise money doesn't mean you spend it type thing. That should be always the case. But, you know, don't take a short-term view, because that's not what your investors are investing in a seed stage company anyways. They're not saying, are you going to survive a year, right? They're still buying into that longer-term vision. So don't kind of have that short-term view. And really, it's I think there's a lot of benefits from kind of a fundraising standpoint. It's just a different environment. You know, there's less of this kind of posturing and FOMO dynamics that was kind of the nature of the fast moving market, where that kind of building that is really effective. It's a much more objective evaluation process now. People are going to be, you know, there for the numbers. So whereas before, having a great pitch, having a great idea, people would really spend a lot of time on that. Is that necessarily making your company more valuable? You know, it depends how you view it, but really the builders are well positioned here. If you're building a great product, you're getting customers, you're showing that product market fit, you're going to get funded. You know, it's really, I think it's going to be more about, you know, the kind of overall, there's a dynamic we talk about in financial markets and assets, but it's a flight to quality, right? In a scary market environment, people do interest rates because they're safer versus, you know, high growth tech companies. I think that the same is going to be the case in venture. You're going to see this flight to quality, where companies that are making money, companies that do have great products that customers love what they're doing, VCs are going to be much more inclined to do them. So it's going to be a much more objective kind of evaluation process. In terms of, you know, how to look at this environment, this is not an environment to ever consider anything a no. You know, and don't consider any conversation to be a no. Consider it a no for now. And stay in touch with people, you know, whereas you mentioned before, it was kind of a 24 hours, you know, by the end of the call, you're giving terms. That's just not necessarily how it's going to be, but that's not necessarily a bad thing. This is a great environment, you know, just as VCs are more selective and really are going to care about who a lot more, you know, when capital is less fungible, who they invest in is going to matter more than ever. Founders should turn that on them and really care about who your investors are. This is a great environment to find the people that you're going to be building your company with for the long term. So, you know, don't consider any conversation no. Stay in touch with people. This is something we've talked about with our companies, is just like, as you're having these discussions and running these processes, you're just going to have to do it on a more rolling basis. You're going to have to look at these environments. And I think that what a lot of investors are going to be looking at is that data over time, right? Looking and checking in with companies more frequently, seeing those kind of monthly or quarterly updates, and looking at how the progress goes over time. So it can be tough because you want to raise money, you want to get more runway, but the reality is that, you know, showing that kind of fact pattern over time of positive momentum, being able to deliver, numbers going in the right direction, you may be, you know, you make it easy for someone to say yes because they feel like they understand the company more, they've seen more. So, you know, stuff to suggest is, you know, again, have you know, you can have your investor updates, but you can kind of have more general updates that you send to a wider group of people, you know, potential partners, et cetera, that kind of, again, stay in front of them without it being, hey, do you want to invest in my company if they've passed, you know, recently.
Absolutely. Gosh, I love all of those tips. And thank you so much, Evan. Last question. Folks watching this online, if they have any questions or interested in connecting, what's the best way to reach you?
You can definitely connect with me on LinkedIn, or you can drop me an email at evan@halolabs.app. Halo Labs is the angel investing group that I'm a part of that's investing over, again, 30 YC companies, including Venue. You can also see us as, you know, YSeed is another way that it comes across. So, you know, feel free to kind of get in touch with me either way. Happy to have these discussions. And thank you, Jeremy, for having me. This has been fun.
Thank you, everybody. If you could hit your one keys for me. Thank you, Evan, for speaking.